The stock market today feels like a one-way bet on technology. The seven biggest tech names now make up more than 30% of the entire S&P 500. Their average forward price to earnings ratio sits between 30 and 35 times, almost twice the market average. It's a level of concentration we have rarely seen outside the dot-com era. But here is what is quietly changing underneath that surface. For the first time in years, capital is starting to move out of big tech. Recent ETF flow data shows billions being withdrawn from large cap technology funds, while cyclical and value sectors record fresh inflows. Even fund managers who have outperformed by riding the AI related names are beginning to trim exposure, citing stretched valuations and crowded positioning. Now, what is driving this? The shift isn't fear, it's opportunity. Investors are realizing that when one sector becomes this dominant, the next wave of returns often emerges somewhere else. The question now is simple: where is that money going? In this video, we are going beyond the headlines of artificial intelligence and semiconductors to uncover the sectors that could quietly lead the next market cycle. Now, these are the industries drawing real cash inflows, trading at reasonable valuations, and supported by policy and demand tailwinds. Stay with us because the next few minutes may show you where the smart money is rotating and why the best opportunities might lie beyond big tech. The goal of this breakdown is fairly simple: to understand where the investors are rotating their capital as big tech valuations stretch and leadership begins to shift. We're not predicting a crash or calling this the top of the technology. Instead, we are mapping how institutional money moves when markets mature. When one sector becomes overcrowded, capital naturally flows into areas with stronger cash flows, cheaper valuations, and clearer policy support. Across the next few minutes, we'll look at 5 such sectors, which is energy, industrials, healthcare, financials, and utilities. For every sector, we'll break down the key performance numbers, macro or policy drivers behind the move, and the exchange-traded funds showing evidence of real inflows. By the end of this video, you will see how the market is broadening beyond the big tech and where the next potential 12% plus annual returns could quietly be forming for 2026. Now, the tech sector is currently trading at nearly twice the S&P's 500 forward earnings multiple, and the expectations for growth are already priced in. That makes every earnings miss, regulation risk, or policy change a potential trigger for volatility. Meanwhile, concentration risk has reached record highs. The top 7 tech companies now drive more than 70% of the index annual gains. When so much of the market depends on so few names, even a small correction can ripple across everything else. At the same time, the macro environment is shifting, inflation is moderating, and the Federal Reserve started cutting rates in 2025 and are expected to do so in 2026 as well. Historically, rate cut cycles tend to favor cyclical and value sectors, areas like energy, industrials, financials, and utilities, because lower borrowing costs and rising investment activity boost their earnings more directly than they do for tech. We are also entering a phase of heavy public and private investment, record infrastructure spending, manufacturing, onshoring, and clean energy buildouts. Now, these trends create durable demand for capital goods, construction, logistics, and energy, precisely the sectors that have lagged behind tech in recent years. The rotation is already visible in the data. ETF flow reports from October show more than $4 billion moving into industrial and financial sector funds, while technology ETFs saw net outflows. Now, that's a clear signal of institutional repositioning. Taken together, the story is simple. After 3 years of one-dimensional market leadership, the investors are beginning to spread out. Not because growth is ending, but because opportunity is expanding. The next market cycle could be defined not by algorithm and chips, but by earnings, dividends, and real-world cash flow. Now, let's talk about energy, value, and cash flow discipline. Now, energy is the first major destination for capital leaving overstretched growth sectors. After the oil price boom of 2022, investor enthusiasm faded and roughly $6 billion flowed out of energy ETFs over the past year. Yet, that pullback has left the sector deeply undervalued. Energy now trades at about half the S&P 500's forward price to earnings ratio, even though companies continue to generate record levels of free cash flow. Since 2022, US oil and gas producers have shifted from aggressive expansion to capital discipline. Nearly 45% of their cash flow has been returned to shareholders through dividends and buybacks. An unprecedented commitment in the sector's history. The shareholder first mindset means even moderate oil prices can deliver solid total return. The macro backdrop is supportive. OPEC plus supply management and rebounding air travel have kept oil prices firm, while the global LNG demand is projected to rise by 60% by 2040. US policy has also turned more pragmatic with faster approvals of pipelines and export terminals, signaling a friendlier stance toward energy infrastructure. Now, when all this adds up to a rare value opportunity, which is high cash flow, moderate valuations, and strong global demand. For investors, energy offers a mix of income and optionality. Dividend yields of 4 to 5% provide a steady base, while any upside surprise in oil or gas prices could amplify returns. The risk remains tied to volatility in crude markets and policy shifts, but valuations already discount much of that uncertainty. Now, when it comes to the ETF highlights, Energy Select Sector SPDR Fund XLE up 1.4% year to date with over $341 million in new inflows in late October, reflecting the renewed confidence in traditional energy producers. Another one is the iShares Global Clean Energy ETF, ICLN, up 35.4% in 2025, adding $55.7 million in a single day as investors pour into renewables. Global clean energy investment hit $386 billion in the first half of the year, and funds like ICLN are capturing that growth. Energy remains a contrarian sector with fundamentals on its side, steady cash returns, undervalued assets, and exposure to both traditional and clean power growth. Now let's talk about the industrials, the manufacturing renaissance. If energy represents value, then industrial represents revival. The United States is in the middle of a manufacturing boom unlike anything seen in decades. Annual investment in new factories and equipment crossed $225 billion in 2024, more than double pre-pandemic levels. This surge has been driven by three policy anchors: the Infrastructure Law, the CHIPS Act, and the Inflation Reduction Act. Together, they have set off a multi-year cycle of spending across semiconductors, EV batteries, clean energy components, and heavy machinery. That policy-driven wave is now translating into corporate earnings and capital flows. In September 2025 alone, the industrial sector ETFs received $2.7 billion of inflows, the highest among all sectors. Institutional investors are positioning early for what they see as a multi-year expansion in constitution, logistics, and advanced manufacturing. Now, the fundamentals support this conviction. Now, companies across construction, aerospace, and automation are seeing stronger order books as onshoring and infrastructure demand accelerate. Supply chains are shortening, new plants are being built closer to end markets, and the US is reclaiming production once offshored decades ago. Added to that impact of artificial intelligence on factory efficiency, from predictive maintenance to robotics, and you have a structural uplift in productivity. The most industrials trade in the mid-teens on earnings multiples with dividend yields between 1 and 3%. Now that leaves room for re-ratings as earnings improve. Now the sectors offers cyclical upside but with less volatility than pure growth plays, making it a balanced option for investors who want exposure to real economy expansion. Now, talking about ETF highlights, Industrial Select Sector SPDR Fund XLI is up 16.5% in 2025 and leading all sectors with more than $504 million of weekly inflows in October. This fund benefits directly from infrastructure and manufacturing activity across machinery, transport, and engineering firms. Another one would be the iShares US Aerospace and Defense ETF, which is up over 50% year to year, recording a massive $1.6 billion inflow in mid-September. The boom in defense orders and export demand has made aerospace one of the 2025's top performing sub-industries. Industrials combine policy support, rising domestic investment, and earnings momentum, a trio that positions the sector as one of the most credible non-tech growth stories heading into 2026. Now let's talk about the healthcare sector, which is going to be a defensive rebound. Now, healthcare has quietly moved from over-owned to overlooked. After the pandemic, investors rotated out of defensive sectors, chasing higher growth areas like technology and AI. The result was 14-month string of fund outflows, the longest in the sector's history. That selling pressure has now made healthcare one of the three cheapest sectors in the S&P 500, alongside energy and financials. Valuations tell the story. Major pharmaceutical companies and managed care firms are trading below their long-term averages, even though earnings remain stable and demand is inelastic. Healthcare spending doesn't disappear in slowdowns. People still need treatment, drugs, and insurance coverage. The steady demand provides a natural hedge against economic volatility. The headwinds that held the sector back are beginning to fade. Policy uncertainty is easing, reimbursement rates are stabilizing, and political gridlock has reduced the risk of new cost control legislation. Meanwhile, the innovation pipeline remains active. Obesity drugs, gene therapies, and AI powered diagnostics are driving the renewed interest in the biotech and life sciences. In 2025 alone, there were about 235 merger and acquisition deals in healthcare industry, a clear signal that the firms are now betting heavily on innovation-led growth. For investors, healthcare offers both income and recovery potential. Dividend yields average between 3 and 4%, and the balance sheets remain strong. The risk lies mainly in regulatory or pricing surprises, but much of that risk is already priced into current value. Now let's talk about the ETF highlights. First one is the Healthcare Select Sector SPDR Fund XLV, which is up 5.3% year to date with roughly $268 million in the new inflows in October as investors rotated back into defensive holding. It provides exposure to large cap pharma and healthcare service leaders. Another one would be the SPDR S&P Biotech ETF XBI, which is up 22.4% this year, benefiting from renewed risk appetite in biotech. Funds like XBI and IYB have seen inflows above $50 million in single sessions, reflecting optimism around clinical breakthroughs and M&A activity. Healthcare stands at the crossroads of defense and disruption, undervalued, cash-rich, and positions for a rebound as investors rediscover the stability and innovation inside this sector. The next one would be the financial sector, from fear to fundamental. Now, financials were left behind during the tech rally, but the tide is turning. After 2 years of rate shocks and recession fears, the sector is showing signs of recovery as investors refocus on earnings and balance sheet strength. Along with energy and healthcare, financials remain among the cheapest segments of the S&P 500, trading at double-digit 15.9 forward price to earnings ratio. The worst-case scenarios that weighed on banks in 2023, deposit flight, loan defaults, and liquidity crunches, never fully materialized. Instead, consumer spending stayed resilient, credit losses remained contained, and capital ratios improved across large institutions. As the yield curve begins to normalize, the earnings outlook for banks and insurers is brightening. A steeper curve means lending margins widen, while funding costs ease, improving profitability across the sector. Investor behavior reflects this shift in the confidence. Over the third quarter of 2025, financial ETFs recorded more than $4 billion of inflows, the second highest amongst all sectors, and the sector's fundamentals are stabilizing just as the macro backdrop turns supportive. Gradual rate cuts in 2026 are expected to lower funding costs without triggering a credit contradiction, the Goldilocks setup banks prefer. Earnings forecasts reinforce this optimism. Analysts project double-digit EPS growth in early 2026 as reserve releases and efficiency gains boost margins. Many banks have restarted share buybacks and dividend hikes after clearing stress tests, with payouts averaging between 3 and 5%. Insurance companies are also benefiting from higher reinvestment yields, adding another layer of income stability. Valuations remain appealing. 7 large-cap banks still trade near or below the book value, while insurers and asset managers command modest multiples despite strong cash flows. So the main risks are the renewed credit stress or tighter regulation, but the probability of either remains low under a steady economic outlook. Now, some of the ETFs highlights. Financial Select Sector SPDR Fund XLF up 10.3% year to date, adding $578 million in early May as investors bought the dip. Wall Street forecast a 15% earnings increase for the sector in the first quarter of 2026. Another one would be the SPDR S&P Regional Banking ETF KRE, which is up 2.3% in 2025, stabilizing after last 5 years sell-off. It recorded a massive $953 million inflow at the end of October, signaling renewed confidence in regional banks as deposits and credit trends improve. Financials now stand as a high-income, low-valuation opportunity, a sector which is regaining investor trust as fundamentals strengthen and fear gives way to steady growth. Now let's talk about the utilities, the yield revival story. Now, utilities have gone from being one of the most ignored corners of the market to one of the most intriguing ones. After years of underperformance driven by rising interest rates, the sector is finally regaining momentum. The Utilities Select Sector Index is up nearly 20% in 2025, and valuations remain attractive compared to historical averages. The catalyst for the turnaround is twofold: failing bond yields and surging electricity demand. As inflation cools and the Federal Reserve signals the multiple rate cuts through 2026, the relative appeal of utilities' steady dividend yields is rising again. Lower rates reduce their financing cost and make their 3 to 5% yields far more competitive versus treasuries. At the same time, a structural demand boom is underway. Power consumption in the United States is growing at its fastest pace since the 1970s, driven by AI, data centers, electric vehicle adoption, and onshoring of manufacturing. Utilities are investing heavily to expand capacity and modernize grids to meet this electrification supercycle. Analysts expect earnings per share for many major utilities to grow between 5 and 7% annually over the next few years, well above the sector's long-term trend. Policy support reinforces the story. Clean energy incentives from the Inflation Reduction Act, streamlined permitting for infrastructure projects, and favorable rate decisions from state regulators have created one of the most stable regulatory backdrop in years for this industry. Whether the political climate leans renewable or traditional, utilities benefit either through extended plant lives and lower compliance costs or through subsidized renewable investments. For investors, utilities offer the rare combination of income stability and growth visibility. Yields remain high, earnings are accelerating, and the sector's sensitivity to rates now works in their favor as the cycle turns. The risk lies in the slower pace rate cuts or unexpected financing pressures, but those are balanced by the defensive nature of the business. Now, here are some of the ETF highlights. First would be the Utilities Select Sector SPDR Fund XLU, which is up 19% year to date, with more than $522 million in inflows during a single week in the fourth quarter. The fund has benefited directly from rising AI-related electricity demand and expectations of lower borrowing costs. Another one would be the Vanguard Utilities ETF, which is up 24.2% in 2025 and drawing nearly $900 million of inflows over 1 month. The dividend yield of around 4% and broad exposure to US power producers, it remains one of the top performers among defensive ETFs this year. Utilities have quietly transformed from a bond substitute into a growth plus yield play. With policy tailwinds, technological demand, and easing rates, the sector may be one of the most consistent performers heading into 2026. Now, what ties them together? Across all 5 sectors, a single pattern stands out, which is the return of fundamentals. Each of these industries share 3 defining traits: lower valuations, stronger cash flows, and steady institutional inflows. Together, they represent the market's quiet shift away from narrative-driven growth and back toward tangible profitability. Energy and financials are the value anchors. Both trade at discounts to the market, generate real cash, and reward shareholders through dividend and buybacks. Industrials capture the growth of policy-driven investment, from factory construction to clean energy infrastructure. Healthcare offers resilience and innovation at once, an unusual combination for a sector priced as defensively as it is today. And utilities, long viewed as slow-moving, are turning into growth enablers as the power grid becomes the backbone of the digital economy. What connects them is not hype but predictability. While technology earnings remain sensitive to cycles of innovation, these sectors are tied to durable trends: energy demand, manufacturing expansion, population health, financial normalization, and electrification. They benefit from the same rate and policy backdrop that now limits big tech's upside. Fund flow data confirms this as rebalancing. In the past quarter alone, industrials and financials drew more than $4 billion of new investment, while large cap technologies ETFs saw sustained outflows. That's not a sign of panic, it's the early stage of rotation. When leadership broadens beyond a handful of high multiple stocks, historically markets become more stable and diversified portfolios outperform. This is the essence of what is happening now. The next leg of the market may not be driven by the excitement of innovation, but by the quiet compounding of industries that actually produce, lend, heal, and power the economy. What this means for investors that there is a shift from big tech isn't a rejection of innovation. It's just basically rebalancing towards sustainability. The market is broadening, and that's healthy. For investors, this rotation opens up opportunities that combine reasonable valuations, solid dividends, and real economic exposure, all without the concentration risk that now defines the tech sector. A diversified allocation of even 20 to 30% across these five areas can stabilize returns while offering meaningful upside. Energy and financials provide income and value protection. Industrials deliver cyclical growth backed by infrastructure and manufacturing expansion. Healthcare offers resilience with a catalyst for re-rating, and utilities add dependable yield with exposure to long-term electrification. This mix also acts as a hedge. If technology corrects, then these sectors tend to hold their ground or even attract inflows. If growth stays strong, they will participate through industrial output, consumer lending, or energy demand. In other words, this is about exiting innovation and it's about owning balance. The data suggests investors and are already making that move. Institutions are trimming positions in crowded tech names and increasing exposure to sectors with improving fundamentals. Historically, such rotations mark the beginning of the broader bull markets, not their end. For long-term investors, the message is clear. As leadership shifts, returns start coming from places that have been ignored. This is the moment to look beyond what's popular and focus on what's quietly compounding value. So, guys, long story short, you should be having a look at all such sectors, because when valuations are shifting and you're finding sectors and ETFs where the valuations are yet to see that expansion, that is where your money should be going. So, do subscribe to the channel for more such insights and keep following us.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.